Imagine a world where the sophisticated, high-performance investment strategies usually reserved for the ultra-wealthy suddenly become accessible to you.
Hmm.
What if you could tap into these advanced approaches, but with a more approachable entry point and, crucially, robust regulatory oversight?
Hmm.
It's an intriguing proposition, isn't it?
It absolutely is. Yeah.
Yeah.
This kind of evolution in the investment landscape, it can be a real game changer for, a significant segment of investors.
Well, today, you're about to embark on a deep dive into precisely that world. India's newest investment frontier, specialized investment funds, or SIFs.
SEFs, right?
This is a genuinely fresh category, having just launched in April 2025, and it's designed to be that much-needed middle ground. Think of it as bridging the gap between your everyday traditional mutual funds and the more exclusive, customized portfolio management services, PMS, or alternative investment funds, AIFs.
Yeah. And what's truly insightful here, I think, is that SIFs aren't just another product off the shelf. They represent a deliberate and strategic evolution. They aim to democratize access to advanced strategies while maintaining the structure and, importantly, the comforting layer of oversight that investors expect from regulated products. It's a very considered step by SEBI.
Okay, so our mission today is to be your guides on this, well, still relatively uncharted territory. We want to equip you with the map and compass to confidently navigate SIFs.
Hmm.
We'll unpack everything from what they are, who they're ideal for, to how they actually work, and perhaps most importantly, how to approach them intelligently, especially if you're a beginner. We'll dive into their unique strategies, those fee structures, and how they might fit to your long-term financial planning.
And this deep dive truly matters because, let's face it, in a world teeming with information, SIFs represent a complex but potentially highly rewarding opportunity. Our goal is to cut through the noise, providing you with the clarity and insight to make genuinely informed decisions about whether this advanced investment tool is the right fit for your portfolio. We're going beyond the headlines to truly understand the why behind this new offering and its implications for your financial journey.
Okay, let's unpack this then and start with the very basics. What exactly are specialized investment funds? Let's set the stage.
Sure. So, at its core, a SIF is a newly regulated pooled investment vehicle in India. SEBI introduced them back in April 2025.
Okay.
And this isn't just, an incremental update. It's an entirely new category,
Yep.
specifically designed to fill a persistent market gap.
A gap. What kind of gap?
Well, for years, many affluent investors often found traditional mutual funds maybe a bit too restrictive, perhaps too simplistic for their sophisticated goals.
Right.
But then on the other hand, PMS or AIFs were either too exclusive, the ticket size was too high, too costly, or they had different regulatory frameworks that didn't quite fit what these investors needed. SIFs stepped directly into this void.
So it's not just a new wrapper for old strategies then. This sounds like a genuinely fresh approach. You mentioned it fills a gap, this middle ground concept. How does that truly work? What makes it a hybrid?
Precisely. It's not just repackaging. Think of it as combining the regulatory comfort, the transparency, and that pooled structure you find in a mutual fund,
Okay.
with the advanced strategic flexibility and the professional management you typically associate with a PMS or an AIF.
Right, the higher end stuff.
Exactly. The true insight here is that for the first time, sophisticated investment strategies, often involving derivatives or niche assets, are accessible at a price point, that 10 lakh minimum, that bridges the gap between everyday funds and those ultra-exclusive options. It's opening up a new tier for affluent retail investors.
So offering more strategic freedom, but still under SEBI's watch.
That's the key. More freedom, but without losing SEBI's robust guidelines.
Okay, to truly appreciate what SIFs offer, we probably need to see them in context. How do they stack up against the investment options we're already familiar with? What's the so what for your portfolio when we look at mutual funds, PMS, and AIFs?
Absolutely. Context is everything here.
Mm-hmm.
Let's start with mutual funds, or MS. We all know them. They're widely known for their simplicity, really low minimums, sometimes just 100, right?
Yeah.
High liquidity, generally easy to get in and out, and pretty standardized strategies. They're excellent for everyone, from first-time investors just looking for diversified exposure to long-term investors seeking passive growth. They pool money, invest broadly, easy entry, easy exit.
Then we have portfolio management services, PMS. These are definitely a step up in terms of personalization.
Yes, very much so.
You get direct ownership of individual stocks in your portfolio. But that comes with a significant minimum investment, typically 50 lakh.
That's the hurdle.
So PMS are really for high net worth individuals, HNIs, who want that active, customized management, a truly bespoke approach tailored to their specific needs.
It's exactly active, tailored, high touch.
And then beyond that, you find alternative investment funds, or AIFs.
Right. The next level up.
These are generally for the ultra HNIs and institutions. We're talking a euro 1 crore minimum investment often.
Typically, yes.
AIFs pool private capital and focus on non-traditional assets, things like private equity, venture capital, hedge funds, maybe real estate.
Exactly. Less liquid, often more complex assets.
And they tend to have lower liquidity and a pass-through taxation structure. What does that mean exactly, pass-through?
Good question. Pass-through taxation means the fund itself isn't taxed on its income. Instead, the income, profits, or losses flow directly through to the investors, and they pay the tax based on their individual circumstances. It avoids double taxation.
Got it. So if that's the spectrum MFs, PMS, AIFs, where does the SEF carve out its distinct niche? What's its unique edge?
Okay, so the SIF very clearly targets affluent investors, people seeking advanced yet tax-efficient strategies.
Affluent, but maybe not quite the ultra HNI level needed for AIFs.
Precisely.
Yeah.
And the minimum investment is the crucial differentiator here.
10 lakh.
10 lakh. That's significant, but a lot lower than 50 lakh or 1 crore.
Exactly. It makes sophisticated strategies significantly more accessible to a broader but still well-capitalized investor base. This is really the first time a vehicle with this kind of strategic depth is available at this price point in India.
And the structure, you said it's a hybrid?
Yes, its structure is hybrid. It retains a mutual fund-like taxation structure, which is a major benefit for investors.
Okay.
But it offers significantly greater flexibility in its investment strategies compared to traditional MFs. For example, SIFs can employ flexible long-short approaches, dynamic asset allocation across equity, debt, hybrid categories, things you just don't see in regular mutual funds.
Let's talk about that taxation for a second. If it's MF-like, does that mean it varies by asset class? What's the core benefit for the investor here? Yes, on taxation, as largely follow the established mutual fund rules. So, equity-oriented strategies, if you hold them for over a year, will typically benefit from the lower long-term capital gains, or LTCG, rates.
Right, the 10% after the exemption.
Exactly. Short-term gains, STCG, are also clearly defined. Debt-oriented strategies are taxed as per the investor's applicable income tax slab rate.
Okay.
The core benefit is that the fund itself doesn't pay tax, thanks to Section 1023D of the Income Tax Act. This pass-through benefit ensures tax efficiency at the fund level, meaning the returns aren't eroded by fund-level taxes before they reach you.
That's a good point of clarity. And what about liquidity? If it's more sophisticated, does that mean it's harder to get your money out quickly?
Generally, yes. Liquidity is moderate and can be highly strategy dependent. It's typically lower than your standard open-ended mutual funds. Some SIFs might have explicit lock-in periods, maybe 12 or 18 months, or they might require a longer notice period for redemptions.
So you need to plan for that.
Absolutely. This is a critical factor for investors to consider. You should assume your capital might be tied up for a period, unlike a daily NAV mutual fund.
Okay, that paints a clearer picture of where SIFs fit. Now let's dig into the key features that truly make SIFs special. This is where they really differentiate themselves.
Yeah, this is where it gets interesting. What's truly fascinating is the sheer flexibility and innovation they offer. SIFs have far greater strategic freedom than MFs.
What does that mean in practice?
It means they can utilize derivatives much more extensively, not just for hedging, but potentially to enhance returns. They can access unique asset classes not typically found in mutual funds. Think direct real estate investments, commodity-linked products, private credit opportunities, or even direct investments in startups.
Wow, okay, startups too.
Potentially, yes, within certain regulatory limits. They can also have very specific sectoral or thematic mandates. And quite significantly, they can employ leverage.
Leverage? How much leverage?
Up to 200% of net assets.
200%. Okay, that sounds like it could amplify returns significantly, but doesn't it also dramatically increase the risk? What exactly does that mean for an investor?
You hit the nail on the head. Leverage means using borrowed capital to invest. It can magnify gains, absolutely, but it equally magnifies losses.
So, double-edged sword.
A very sharp one.
Yeah.
While it offers the potential for higher returns, it undeniably elevates the risk profile of the fund quite substantially. It's a powerful tool, but one that requires really sophisticated management and a robust risk framework, which, thankfully, SEBI mandates for SIFs.
So the key insight isn't just that SIFs can do more exotic things.
No, it's that they offer a tool for strategic enhancement that was previously out of reach for this segment of investors. It pushes the boundaries of what regulated products can achieve for you, but you must understand that it comes with a proportional increase in risk.
That sounds like a whole different ball game compared to what many investors are used to. But with that kind of flexibility and amplified risk, you absolutely need top-tier talent managing these funds, right?
Absolutely. The professional management aspect is paramount. SEBI knew this and established strict criteria for the asset management companies, AMCs, and their chief investment officers, CIOs.
What are those criteria?
An AMC must have been operating for at least 3 years, and importantly, must have a substantial average asset under management, AUM, at least 10,000 crores in the preceding 3 years in their mutual fund business.
10,000 crore. Okay, so established players.
Yes, and for the SIF CIO specifically, they need at least 10 years of fund management experience, and they must have managed an average AUM of no less than 5,000 crores during that time.
Wow. So serious experience required.
Definitely. This ensures that only highly experienced professionals, people who've managed significant assets through different market cycles, are at the helm. It's a crucial safeguard for investors diving into these more complex strategies.
So we're talking about serious players here. And what about safety nets? With all this flexibility and potential for leverage, what kind of regulatory oversight is in place to protect investors? Is it as strong as for mutual funds?
That's a key point of comfort. And yes, the oversight is strong. SIFs are explicitly SEBI regulated. This means they operate within defined risk parameters, they're subject to regular disclosures, portfolio holdings, NAV calculations, and they come with investor protection measures, much like mutual funds.
Okay.
This robust regulatory framework provides that layer of credibility and transparency. It differentiates them significantly from, say, less regulated private pools of capital or offshore funds. You're getting advanced strategies, but within a familiar, governed environment.
And you mentioned agility earlier. How does that play out?
Indeed. They're designed to offer more agile and innovative solutions. Because their mandates can be more flexible, they can potentially adapt more quickly to evolving investor needs or capture unique, perhaps short-term market opportunities. Something traditional mutual funds, with their often stricter, broader mandates, might struggle to do as nimbly. It's about responsiveness.
All right, that gives us a fantastic overview of what SIFs are. Now let's try to bring this to life with a real-world example. We're going inside Edelweiss Altiva SIF to get a glimpse into how a major player is approaching this new category.
Good idea. Edelweiss has clearly articulated their vision for Altiva. They're positioning it as a platform where wealth meets vision.
Kitschy.
It is. Their stated purpose is that it's designed for investors who seek focus, not noise. People who prioritize long-term conviction over chasing short-term market fluctuations.
Focus, not noise. I like that.
It's about offering curated investment opportunities that are aligned with what they call elevated financial goals. It aims to embody clarity of purpose and strategic insight.
And how do they translate that vision, that focus, not noise idea, into their actual investment approach? What's the philosophy?
Their investment philosophy is distilled into 3 words: disciplined, consistent, true to label.
Okay. Disciplined, consistent, true to label. What does that mean in practice?
It means their approach is anchored in a clearly defined investment process and, crucially, robust risk management. They aim to balance growth potential with prudence, not chasing returns at any cost. And true to label means ensuring portfolios remain consistent with their stated investment styles, aiming for transparency and delivering enduring value based on that style.
And their framework for achieving this.
Their framework is summed up as process-driven, style-agnostic, strong governance.
Let's break that down. Process-driven.
Meaning each fund operates within clearly defined boundaries or guardrails. This aims for consistency in approach across different market cycles.
Style agnostic. That's interesting.
Yes, it means they focus on investing in strong businesses with long-term potential, rather than being confined to a rigid value or growth box. They look for quality regardless of style label.
And strong governance.
This means every potential investment is rigorously assessed, not just for financial quality, but also for governance standards and the credibility of its ownership and management.
Okay, so a strong emphasis on process and governance. That sounds reassuring for complex products like SIFs. And who's at the helm? Knowing the leadership behind these sophisticated instruments is crucial, as we discussed.
Absolutely. The leadership is often a key differentiator, especially in a new category. For instance, you look at Ms. Radhika Gupta, the MD and CEO of Edelweiss Asset Management. Her track record is quite impressive.
Tell us a bit about that.
Well, she's widely credited with transforming Edelweiss Asset Management, significantly growing its assets under management, from around INR 6,500 crore to over INR 1.05 lakh crore. She also spearheaded the crucial acquisition of JP Morgan Mutual Fund in India
Right, I remember.
and launched India's first corporate bond ETF, the Bharat Bond ETF, which was a major innovation.
Huge success, the Bharat Bond ETF.
Absolutely. Her leadership really underscores the caliber of talent guiding these new SIFs. It reflects a commitment to innovation, building a robust retail brand, and strategic vision within the Indian asset management industry. You're essentially investing alongside a leader who has demonstrated significant impact.
And she's quite visible too, isn't she, with her advocacy work?
Yes, she's also known for her advocacy for financial literacy and mental well-being, often sharing her own story as the girl with the broken neck and through her book Limitless. It adds a different dimension to the leadership profile.
That's a fantastic illustration of the kind of expertise and vision required to lead in this new SIF space. But remember, as you said, this is a brand new race. Edelweiss is one player, albeit a significant one. What does the broader SIF landscape look like right now? Who else is vying for investor attention as of, say, September 2025?
You're right, it truly is a brand new race. SIFs are very, very new to the Indian market. Most AMCs only received their SEBI approvals sometime during 2025.
So very recent.
Extremely recent. This means there's very limited historical performance data available for actual SIFs, but it also means there are significant first-mover advantages for those quick to launch and establish themselves. It's an evolving landscape right before our eyes.
Okay, so who are the trailblazers? Who's actually got a product out there running right now?
The primary trailblazer, the first one out of the gate, is Quant Mutual Fund. They launched their QSIF Equity Long-Short Fund back in August 2025.
August 25, so just last month, essentially.
Pretty much. It was the very first operational SIF. This particular fund uses quantitative models, quant specialty for long-short equity strategies. It invests across large, mid, and small caps, and the stated aim is to generate absolute returns even when markets are volatile.
And Quant is known for its quant models. Are they planning others?
Yes, reports suggest Quant is also preparing additional SIF launches, likely exploring other strategies like maybe an X-Top 100 long-short fund and possibly hybrid strategies too. They seem keen to build out a suite.
So Quant really is setting the pace. What about other major players? Who's in the soon-to-be category? Who has announced plans or filed documents with SEBI?
Oh, many of the big names are definitely getting ready. You've got ICICI Prudential AMC, for example. They've filed draft documents for several SIFs, long-short, an X-Top 100 equity strategy, and even a sector rotation fund. Their filings indicate a focus on flexible mandates and using derivatives.
Okay, ICICI Pru is in. Who else?
HDFC AMC is also preparing to enter the fray. They're looking at long, short, and tactical allocation funds, likely positioning them with a focus on risk-managed approaches tailored for affluent investors.
Makes sense for HDFC. Any others?
Yes, several others have made announcements or are believed to be in the pipeline. Nippon India, Edelweiss, beyond altiva, perhaps more strategies, SBI MF, Aditya Birla Sun Life, Axis, all of these major AMCs have announced early SIF strategies or are understood to be in various stages of finalizing plans, getting approvals, and preparing for launch.
So it's quickly becoming a crowded field, or at least it will be soon.
It looks that way. The competition is heating up.
Are there any common threads that we can identify among these leading SIFs right now based on what's launched or announced?
Yes, there are definite common threads emerging. Universally, they all adhere to the minimum investment requirement set by SEBI, which is 10 lakh.
Okay, that's standard across the board.
Absolutely. Their strategy focus is also consistently leaning towards high-risk, high-flexibility mandates. Things like long-short equity, dynamic sector rotation, and derivatives-based risk management seem to be popular initial themes.
Which naturally defines their target audience.
Exactly. The target audience clearly caters to advanced, sophisticated investors who understand or are willing to learn about these complexities and the associated risks. And regarding their current status, as we noted, most are still in pre-launch or approval phases. Quant is the main one with actual public track record details, however short. We should expect a wave of more launches through late 2025 and definitely into 2026.
So the key takeaway here for you, the listener, is that the market is evolving rapidly. While Quant is the early option, ongoing research into these new launches from other major players is absolutely crucial. You need to stay informed to make the best decisions as more choices become available.
Indeed. Given the novelty, constant vigilance, independent research, maybe talking to your advisor, these are essential to understand the new offerings as they come out and grasp their specific risk-reward profiles. Don't just jump on the first one you see.
That's sound advice. This brings us to a really critical section, navigating SIFs focusing on the investor profile and suitability. The fundamental question is this actually for you? We've already mentioned that SIFs are generally not recommended for new investors. Why is that? Why are they tailored for those with a higher risk appetite and adequate financial knowledge? Let's truly unpack this for our listeners because the 10 lakh minimum might tempt people who aren't quite ready.
This is a vital point, you're right. It addresses the core nature of SIFs. The primary reason they're not for beginners lies squarely in their risk characteristics.
Okay, let's talk risk.
First off, you have potentially high risk and volatility. The advanced strategies they employ, like extensive use of derivatives, long-short equity plays, potentially concentrated sectoral bets, alternative assets, these inherently mean potentially higher volatility and steeper drawdowns compared to your average diversified mutual fund.
Drawdowns meaning bigger drops in value during market downturns.
Exactly. Even though derivatives exposure is capped by SEBI at 25% of net assets for hedging and portfolio balancing, that still significantly elevates the risk profile compared to a fund that barely touches derivatives. Your capital could fluctuate much more dramatically, both up and down.
So it's definitely not going to be a smooth, gentle ride. And strategies themselves are more complex, I assume. They require a certain level of understanding from the investor.
Precisely. These aren't your typical buy and hold equity or debt funds. They involve techniques like short selling, betting on prices going down, leverage which, as we discussed, magnifies both gains and losses, complex multi-asset allocation, and investments in niche areas like REITs or invites, often beyond the typical limits allowed in standard mutual funds.
Right.
This inherent complexity requires a deeper understanding from the investor. You really need to grasp what's happening under the hood to be comfortable, especially when things get choppy.
And what about getting your money out? We touched on liquidity earlier, but it bears repeating in the context of suitability.
Yes, liquidity constraints are another major factor making them unsuitable for beginners or those needing easy access to funds. Redemption terms can vary significantly. Some SIFs will have explicit lock-in periods. Others might not have a hard lock-in, but could require much longer notice periods for redemptions compared to an open-ended mutual fund, think weeks or even months potentially.
So definitely not your emergency fund money.
Absolutely not. If you anticipate needing quick access to your money for any reason, this is a crucial consideration that might make SIFs entirely unsuitable for that portion of your capital.
And what about the cost? Is this sophistication expensive? Does that affect suitability?
It does, because higher costs mean the fund has a higher bar to clear just to deliver returns to you. SIFs come with higher fees than standard mutual funds. Beyond the annual management fees, they often include a performance fee, typically 10% to 20%.
A performance fee? How does that work?
It's usually charged only on profits above a predefined minimum return threshold, known as the hurdle rate. So the fund has to perform well, exceeding that hurdle, before this extra fee kicks in.
Is there any protection for the investor if the fund value goes down?
Yes, usually there's a high watermark principle applied. This means if the fund value drops, you don't pay performance fees again until the value recovers past its previous peak where fees were last charged. It prevents you from paying performance fees on the same gains twice, or on just recouping losses.
Okay, that's important. But still, the overall cost is higher.
Definitely. The combination of management fees and potential performance fees means the fund needs to generate significant gross returns just to deliver decent net returns to you after all costs are deducted. This demands a higher performance threshold.
And of course, the final point on suitability, they're so new.
Exactly. Being a brand new category, launched only in April 2025, there's a limited track record. Real long-term historical performance data for Indian SIFs is virtually non-existent right now.
So you're betting on the manager and the strategy description?
Pretty much. This requires a leap of faith based on the reputation of the AMC, the experience of the management team, and your belief in the stated strategy, rather than relying on years of proven performance data like you might with an established mutual fund. This inherent uncertainty is another reason they're better suited for more experienced investors.
Okay, so with those significant risk characteristics in mind, volatility, complexity, liquidity constraints, higher fees, limited track record, what's the recommended investor profile? Who are SIFs actually for?
Right, let's define that ideal profile. First and foremost, you need financial stability. An investment in a SIF should only ever be part of a well-diversified overall portfolio. You must be able to comfortably meet that 10 lakh minimum investment without dipping into your emergency fund or impacting money set aside for other critical financial goals like near-term education fees or down payments.
So, strictly surplus capital. Capital you can afford to lose, theoretically.
That's perhaps a stark way to put it, but yes, it needs to be capital you can afford to see fluctuate significantly without causing you financial distress or forcing you to sell at the wrong time. This isn't for your core essential savings.
Got it. What's next?
Second, you must possess a genuinely higher risk tolerance. You need to be psychologically prepared for and comfortable with potential capital volatility and even periods of loss, all in the pursuit of potentially higher long-term returns. This is definitely not for the faint of heart or investors whose primary goal is capital preservation.
And how long should you plan to keep your money in these funds? Is it a short-term play?
Absolutely not. A long-term horizon is essential. Ideally, you should be thinking of an investment tenure of 3-5 years minimum, preferably longer. This allows the sophisticated strategies time to play out across different market cycles and lets your capital potentially grow. Frequent switching in and out will likely be detrimental due to potential exit loads, transaction cost, and just missing the strategy's intended run. These are not short-term trading vehicles.
3 to 5 years minimum. Okay. What about knowledge level? Can someone invest passively?
No, market knowledge is pretty much indispensable. You need a solid understanding of complex financial products, the specific fund strategies being employed, like long-short or using derivatives, and basic risk management techniques. These are not suitable for passive, set-it-and-forget-it investors. You need to understand what's happening under the hood to make informed decisions and stay comfortable during volatile periods.
And that leads into the final point here, which is about ongoing engagement, right?
Right. SIFs require active monitoring. You can't just put your money in and forget about it for 5 years. You'll need to engage periodically, review the reports and disclosures provided by the fund manager, track performance relative to expectations and benchmarks, and generally stay informed. Transparency is provided, and investors are expected to utilize it.
Okay, for you, the listener, let's try to crystallize this with a quick self-assessment. Think of this as a mini quiz before you even consider looking at SIFs. Ask yourself these 5 questions.
It's a good idea.
1. Can you comfortably invest 10 lakh right now without affecting your emergency fund or any critical near-term financial goals? 2. Are you genuinely comfortable with the idea of potentially higher volatility, bigger swings in value compared to traditional mutual funds? Can you stomach potential losses without panicking?
Crucial point.
3. Can you commit to staying invested for a minimum of 3 to 5 years, ideally longer, without needing to pull the money out?
Patience is key.
4. Do you have a solid understanding of basic investment concepts like equity, debt, and what derivatives are, even at a high level?
Foundational knowledge.
And finally, 5. If you invest, will this SIF allocation represent less than 10% of your total investment portfolio?
Diversification check.
If you answered no to any of those questions, SIFs might not be the right fit for you right now, and that's perfectly okay. There are plenty of other great investment options.
That's a great way to frame it. It really reinforces the importance of self-awareness and suitability before diving into these advanced products. It's better to wait until you're ready than to jump in too soon.
Absolutely. Building on that, let's talk about strategic allocation for beginners and maybe even for the cautious learner who does meet the criteria but is considering SIFs for the very first time. What's the golden rule here? How should they think about allocation?
The golden rule is simple and crucial. Start small. Don't make SIFs the core of your portfolio initially. They are best recommended as a small, tactical, or satellite allocation.
Satellite, meaning orbiting around a core.
Exactly. They should complement your core holdings. Things like diversified mutual funds, direct stocks, bonds. They should enhance your portfolio, perhaps add a different return driver or diversification, but not define it, especially at the beginning.
So definitely not something to go all in on from day one, even if you have the 10 lakh. What kind of initial exposure are we talking about for a beginner who qualifies?
For beginners, even qualifying ones, starting with 5% to 10% of your total investable portfolio allocated to SIFs is generally a prudent approach.
5 to 10%, okay.
This allows you to gain access to those advanced strategies, get a feel for how they behave, while significantly limiting the impact on your overall portfolio if the SIF experiences high volatility or underperforms initially. It's about dipping your toes in, gaining experience and comfort, rather than plunging headfirst.
And how does age and risk tolerance factor into this allocation, even within that 5–10% band, or maybe slightly beyond for some? Should a younger investor approach this differently than someone closer to retirement?
Absolutely. There should be a clear age and risk tolerance adjustment when thinking about SIF allocation. For younger investors, let's say their 20s or early 30s, they typically have a higher risk appetite and much longer time horizons. So they might lean towards the higher end of that initial range, perhaps 8% to 10%, maybe even slightly more if their overall profile supports it.
Okay, longer runway can take more risk.
Right. As investors move into their middle-aged years, so say their late 30s and 40s, they often have moderate risk tolerance and other financial priorities start emerging: home loans, kids' education, etc. They might want to dial back the exposure to more complex, less liquid assets. So maybe reducing SIF allocation to somewhere in the 3% to 7% range could be sensible.
Gradually de-risking as responsibilities grow. Makes sense.
Exactly. The idea is that as your financial responsibilities grow and your time horizon shortens, you typically want to reduce your exposure to higher risk, potentially less liquid investments.
And as you get even closer to retirement, say late 40s, 50s,
For later career investors, perhaps in their late 40s and 50s, the focus generally begins to shift more decisively towards capital preservation and generating income for the future. So a further reduction in SIF allocation, perhaps down to 2% to 5% of their portfolio, might be prudent.
and for those right near or actually in retirement, 60s and beyond,
For those near or in retirement, say 50s nearing retirement, 60s or beyond, the primary focus shifts predominantly to stable income generation and risk minimization. Here, minimal or even no SIF allocation is generally recommended, maybe 0% to 1% or 2% at the absolute maximum, and only if they have substantial other assets and fully understand the risks. Liquidity and volatility concerns become paramount in retirement.
that makes perfect sense. It follows general investment wisdom about asset allocation over a lifetime. The rule of 110 or similar guidelines for overall equity allocation would still apply, I imagine. SES would just be a more aggressive or complex subcomponent within that equity alternative sleeve.
Precisely. It's a good general reminder. Your overall asset allocation rules still apply. SIFs would represent a sophisticated equity or alternative subcomponent within that broader framework. You wouldn't suddenly allocate 30% to SIFs just because you can if your overall equity limit is, say, 60%.
Right.
However, the really important caveat here is that while age is a useful guideline, your personal risk tolerance, your specific financial situation, and your unique goals should always be the ultimate decider. Your comfort level and financial needs are paramount, regardless of age brackets.
Good point. Now, if someone is already diversified within alternatives, perhaps they already hold some REITs, maybe some gold via ETFs or other private equity investments. How do SIPs fit into that? Do they just add on top?
That's a great question. No, they don't just add on top. If you're already holding other alternative investments, you need to consider your total alternative exposure. Generally, for beginners or even moderately experienced investors, keeping the total allocation to all alternatives, including SIFs, REITs, gold, private equity, etc., below, say, 20% of the portfolio is often advised.
Okay, so SIFs fit within that broader alternatives bucket.
Exactly. You need to factor your SIF allocation into that overall alternative sleeve to ensure you're not inadvertently becoming overexposed to these less traditional, potentially less liquid, and often more complex asset classes. Proper diversification means balancing across all categories.
And for those who start small, maybe with that 5%, but find they are comfortable and want to eventually increase their exposure as they learn more, what's the wise way to approach scaling up?
We strongly encourage a gradual increase only as understanding and comfort grow. Start with that minimum euro lakh investment, perhaps in a single SIF representing that initial 5–10% allocation. Live with it for a while, maybe 6 months, a year. Track it, understand its movements. Only add more exposure, perhaps another tranche, maybe diversifying into a second SIF with a different strategy as your confidence builds, your experience with the product grows, and you've seen how it performs in different market conditions.
So learn by doing, but cautiously.
Exactly. This hands-on learning, combined with diligent monitoring and a clear understanding of the fund's performance relative to its goals and your own comfort level, is invaluable. Don't rush to increase allocation just because the initial returns look good.
Okay, to make this really concrete for you, the listener, let's look at a sample beginner portfolio allocation, including SIFs. This is just an example, of course, tailored to a hypothetical investor with moderate risk tolerance.
Examples help.
Imagine you allocate, say, 40% to large cap stocks or corresponding mutual funds ETFs, 15% to mid-small cap stocks or funds, 25% to diversified mutual funds, maybe some balance advantage or flexicap funds, 15% to bonds or other relatively risk-free assets like PPF, fixed deposits, and then a 5% allocation to specialized investment funds, SIFs.
Right. What this clearly shows you is that in a balanced approach for someone starting out, SIs are intentionally a small specialist allocation. They sit within a robust, diversified portfolio that contains safer core assets, like bonds, and traditional growth assets, like large mid-cap equity funds.
So they're a tool for enhancement, maybe diversification, but definitely not the foundation of your investment strategy at this stage.
Precisely, though, the spice, not the main course, especially
Yeah,
when you're beginning.
that's a very practical breakdown. Now let's move to the actual path to investing. A comprehensive guide for new IF investors. Assuming someone has done the self-assessment, meets the criteria, and decided on a small allocation, what's the very first phase of the process, even before they start looking at specific funds?
Okay, the first active phase is all about phase one, self-assessment and preparation. This is effectively the homework you need to do before you even think about shortlisting or investing in a specific SEF. This is where you confirm your readiness in detail.
Right, we touched on the self-assessment quiz, but let's quickly reiterate that financial readiness checklist from a process perspective. It's important enough to hear again before moving forward.
Indeed, it's crucial to formally reconfirm. Can you comfortably invest the minimum 10 lakh without impacting essential funds? Check your surplus. Does your risk tolerance genuinely align with potentially higher volatility? Be honest with yourself. Do you have an investment horizon of at least 3 to 5 years for this specific money? Confirm the time frame.
Yeah.
Do you have a foundational knowledge of basic investment concepts, equity, debt, derivatives? Identify any gaps to fill.
That's right.
And finally, confirm that the planned SEF allocation will remain less than 10%, or your pre-decided small percentage, of your total investment portfolio. Calculate the allocation.
Okay, check. Beyond just ticking those boxes, what kind of educational foundation should a new investor build specifically about SEFs before proceeding?
It's highly recommended to actually read SEBI's official SIF regulation document, or at least summaries of it, to understand the legal framework they operate under.
Okay, go to the source.
Yes. Then make sure you clearly understand the differences in structure, strategy, fees, liquidity, taxation between SIFs, traditional mutual funds, and PMS offerings. Don't confuse them. Learn about the specific types of strategies Fs often employ, like long-short equity, private credit, thematic investing. Understand what they mean, how they work conceptually. Watching educational webinars or reading primers from established AMCs or independent financial educators can also be very insightful. Look for unbiased sources.
So, some action items from this preparation phase before moving to market research.
Yes, the key action items are: 1. Calculate your actual investable surplus available for high-risk investments. 2. Formally decide on your SIF allocation percentage based on your overall portfolio and risk profile. 3. Ensure your Know Your Customer, KYC, is complete and up to date with a registered broker, distributor, or investment platform you might use. This sets the essential groundwork before you even start looking at specific SIF options.
All right, once that self-assessment and preparation homework is thoroughly done, what's phase 2? Market research and AMC analysis. This is about finding the right potential partners, the right fund houses.
Exactly. Step 1 here is identifying eligible AMCs. Where do you find them?
Good question. Where?
Your primary research sources should include the SEBI website, which lists all registered SEF AMCs. That's the official source.
Yeah.
You should also look at individual AMC websites and their annual reports. Financial news portals often cover new fund launches, including SIFs, and industry reports from rating agencies like CRISIL or IPA can sometimes provide valuable insights into the players in this space and their capabilities.
And what evaluation criteria should investors use for assessing these AMCs, especially given that SEBI has already set a high bar for eligibility? What should we look for beyond the basics?
Beyond SEBI's minimums, 3+ years, 10K crore MFAUM. Look for an AMC with a strong, long-term track record in managing complex strategies, if possible, even before SIFs existed, for example, in their PMS or AIF divisions, if any. Check the specific CIO's credentials for the SIF that 10+ years experience managing 5K plus crore AUM is key, but also look at their specific expertise relevant to the SIF strategy.
Right.
Ensure the AMC has a clear, understandable investment philosophy that resonates with you. Look for a strong record of regulatory compliance. Any major SEBI penalties or issues in the past would be a red flag. And crucially, assess their commitment to transparency. How regularly and clearly do they communicate with investors? Do they provide timely and detailed disclosures?
That seems like a very high bar for the management teams, which is reassuring for investors.
Hmm.
Once you have a short list of potentially suitable AMCs, how do you research the specific SIF strategies they offer? It's not just about the AMC brand, right?
Absolutely not. The strategy is paramount. Step 2 is strategy research. I recommend creating a comparison sheet for the different SIFs you're considering.
What should be on this sheet?
Note down the specific strategy type. Is it equity, long-short, absolute return, private credit, thematic, like AI or clean energy, multi-asset? Assess the stated risk level, usually categorized by the AMC. Look at their expected return targets, with a pinch of salt, of course. Check any available historical volatility data, maybe from backtesting or similar international strategies if disclosed. Understand the liquidity terms very clearly, lock-ins, notice periods. Compare expense ratios and the full fee structure, including performance fees and hurdles. Note any lock-in periods or exit loads.
And what key questions should you be asking yourself as you compare these strategies?
Ask things like, what specific market conditions are likely to favor this particular strategy? When might it underperform? How has a similar strategy, maybe run by the same manager elsewhere or internationally, performed in past market cycles, especially downturns? What are the key risk factors unique to this specific approach? And again, critically, how liquid is this investment really? When can I realistically expect to get my money back if needed? And what are the penalties?
That brings us to phase 3, deep dive analysis. You've done the prep, researched AMCs, compared strategies, and now you have a short list of maybe 1 or 2 Fs. It's time to get really under the hood. What documentation should investors be reviewing meticulously at this stage?
This is where you need to roll up your sleeves. For each shortlisted SEF, you absolutely must read the complete scheme information document, SID, and the key information memorandum, QMI. These are your primary legal and informational documents.
And SID, that's the big one, right?
Often quite long. It can be, yes, but it contains crucial details. Don't skip it. Also, review the latest portfolio disclosure statement. This tells you what assets the fund actually holds right now. Carefully analyze all risk warnings and disclaimers. They are there for a reason. Study the full fee structure section again, including how expense ratios and performance fees are calculated and charged. Double-check the exit load structure and precise redemption terms. Notice periods, payout timelines. All of this information is mandated to be transparent by SEBI, so utilize it fully. Don't rely on marketing brochures alone.
And how should an investor approach risk assessment at this deep dive stage? It sounds like there are many layers of risk with SEFs beyond just market ups and downs.
Yes, the risk assessment needs to be multifaceted. I suggest creating a simple risk assessment framework or matrix for each F you're seriously considering.
What factors should be in this matrix?
You need to consider market risk. How sensitive is this strategy likely to be to broader market movements, or e.g. interest rate changes, equity market direction? Strategy risk. How complex is the strategy itself? What are its inherent vulnerabilities? e.g. a long-short strategy might struggle in strongly trending markets. A concentrated thematic bet carries specific sector risk. What happens if the manager's edge disappears? Manager risk. How dependent is the fund's success on the specific skills of the current fund manager or CIO? What happens if they leave? Key person risk. Liquidity risk. Reconfirm exactly how quickly you can exit your investment without significant penalty under normal and stressed market conditions. Concentration risk. Look at the portfolio disclosure. Is the fund highly concentrated in a few stocks, sectors, or issuers? Higher concentration usually means higher risk. Counterparty risk. Especially if derivatives are used, who are the counterparties? Is there a risk they might default? Leverage risk. If the fund uses leverage, fully understand how much and how it impacts potential gains and losses.
This sounds like a significant amount of work, but absolutely essential for such a complex product with a high entry ticket. For our listeners who might feel overwhelmed by that list, what would be the absolute key categories to focus on for due diligence, a sort of minimum checklist within this deep dive?
That's a fair point. If you're feeling overwhelmed, focus intensely on these 5 critical areas from the due diligence checklist mentioned in our research. 1. Define investment objectives and suitability. Does this specific SEF's goal, risk profile, and required investment horizon truly align with your personal financial goals, risk tolerance, and timeline? Does the 10 lakh minimum fit comfortably? Reconfirm suitability. 2. Understand fund strategy and thesis. Do you clearly understand the investment mandate? What is the core idea or thesis behind the strategy? Why does the manager believe it will generate returns? Does it make sense to you and align with your market outlook? 3. Evaluate fund management team. Go beyond the name. Research the specific fund managers and CIO's track record, their tenure at the firm, and their experience with similar complex strategies. This is absolutely crucial given the newness of SEFs as a category. Look for stability and relevant expertise. Remember, CIO 10 plus years, 5K CRH AUM managed. 4. Analyze historical and risk-adjusted performance, if available. Since inception data will be short, look closely if provided. Compare against relevant benchmarks. Crucially, look at risk-adjusted return metrics like the Sharpe ratio, return per unit of risk, and Sortino ratio, return per unit of downside risk. Examine the maximum drawdown, the largest peak-to-trough decline. This tells you about the fund's potential downside resilience in bad times. 5. Review fund terms and fee structure. Understand all the fees management performance and its hurdle high watermark, total expense ratio, any transaction costs, and exit loads. How are they calculated? When are they triggered? Clarity on how these fees impact your potential net returns is paramount. Check liquidity terms, lock-in, notice periods, penalties, one last time.
That's incredibly practical and drills down to the essentials.
Okay, assuming an investor has done all that rigorous due diligence and is ready to proceed, what's phase 4? Implementation strategy, actually making your first move into a SIF.
Right, pulling the trigger. For first-time SAVE investors, even after all the homework, we strongly recommend a conservative start to the actual investment process.
How so?
Consider beginning with only about 50% of your initially planned SIF allocation. So if you decided 5% of your portfolio is right, maybe start by investing only 2.5% initially.
Okay, phase it in.
Exactly. In terms of strategy selection, choose just 1 or 2 strategies maximum initially. Don't try to build a complex SIF portfolio from day one. Keep it simple.
And diversification.
For diversification at this initial stage, you could consider splitting your small allocation between 2 different strategies, perhaps from the same or different AMCs if you've done diligence on both. But again, keep it manageable.
What about timing the market? Should you invest the lump sum at once? Given the potential volatility and the fact that you're new to this, timing is tricky. Consider dollar cost averaging your investment over a period of, say, 3 to 6 months, especially if the SIF allows SIPs, or you can make multiple tranches. This phased approach can smooth out your entry point and reduce the risk of investing everything at a market peak.
So a phased, cautious approach even for the actual investment. What's the step-by-step mechanical process once you're ready to commit that first tranche?
Okay, the mechanics. Step 1. Account setup and KYC. Ensure your enhanced KYC is fully completed with your chosen distributor, broker, or online platform. You'll likely need to submit income proof and net worth documentation as SR for affluent investors. Set up any bank mandates for auto debit if using SIP or making future investments. Step 2. Application process. Carefully fill out the SIF application form, ensuring you use the correct scheme codes. Submit the necessary bank details. Provide all required documentation, PAN, Aadhaar, income proof, etc. Verify that your investment amount meets the 10 lakh minimum per application. Step 3. Post-investment setup. Once the units are allotted, register for online access to track your portfolio. Set up mobile or email alerts for NAV updates or any important communications from the AMC. Critically, schedule regular reminders for yourself, perhaps quarterly, to review the SIF's performance and disclosures. Maybe even create a simple personal spreadsheet to track its performance against your expectations.
The bottom line here for you, the listener, seems loud and clear. This is absolutely not a passive investment. It requires real commitment and ongoing engagement from your side right from the start.
Absolutely. You have to treat it as a serious part of your financial architecture, one that requires regular attention, critical assessment, and informed decision-making. It's definitely not a set-it-and-forget-it product like some index funds might be.
Now let's talk directly about the cost of this sophistication. SIF fee structures, we've touched on them, but let's dedicate a section to understanding them properly. These are definitely higher than your regular mutual funds, reflecting the advanced strategies and management involved. What's the typical price tag look like?
Yes, SIF fees are indeed significantly higher than regular mutual funds. They more closely resemble the fee models you see in PMS and AIFs. This reflects the complexity of the strategies being run, the specialized management expertise required, and often the enhanced reporting or services provided to SIF investors. You're essentially paying a premium for a higher level of expertise and greater strategic flexibility.
Okay, let's break down the typical fee schedule components. What are investors actually paying for line by line when they invest in a SIF?
All right, let's list them out. First, there might be an entry fee or subscription fee. This is usually between 0% and 1% of the amount you invest, charged up front. However, it's worth noting that many SIFs are currently waiving this entry load to attract initial investors, but always check the specific SID. The main ongoing cost is the annual management fee. This typically ranges from 1.25% to 2.0% of the assets under management AUM per year. This fee is charged periodically, like quarterly or annually, based on the value of your investment, and importantly, it's charged regardless of whether the fund makes positive returns or not. It's the fixed cost for the professional management service.
1.25 to 2%. Okay, that's noticeably higher than most direct plan mutual funds. What about the total expense ratio, or TER? How does that fit in?
The total expense ratio, TER, gives you a broader picture of the annual operating costs. It typically ranges from 1.00% to 2.25% of AUM for SIFs. This tier includes the management fee we just discussed, plus other operational costs like administration, registrar fees, custody charges, audit fees, etc. SEBI does put a cap on the maximum tier allowed for SIFs, providing some level of cost control.
Right, so the TERS is the all-in operating cost, excluding performance fees and transaction costs. Let's talk about that performance fee again, the carry fee, as it's sometimes called in the AIF world.
Yes, the performance fee or carry fee. This is a variable fee, typically ranging from 10% to 20%. But the key is that it's charged only on the profits the fund generates above a certain predefined minimum return threshold, which is called the hurdle rate.
Okay, explain the hurdle rate.
The hurdle rate is the minimum annual rate of return the SIF must achieve before the performance fee calculation even begins. It's commonly set between 10% and 12% per year. So, if the hurdle is 10% and the fund returns 15%, the performance fee, say 15%, is only applied to the 5% return above the hurdle. If the fund returns only 8%, no performance fee is charged for that year.
And you mentioned the high water mark earlier. That's crucial here, too.
Absolutely crucial. The high water mark HWM principle usually applies. This means that if the fund's NAV drops below its previous highest point, the last point at which a performance fee was charged, no new performance fee can be charged until the NAV recovers and exceeds that previous peak. It ensures investors don't pay performance fees multiple times on the same gains or just for recouping losses. Always check the SID to confirm the HWM application.
Got it. Are there any exit fees to worry about, similar to exit loads in some mutual funds?
Yes, potentially. An exit fee or redemption fee might apply if you redeem your units within a specified period, often 12 to 18 months from investment. This fee could range from 0% to 2% of the redemption value. It's designed to discourage short-term trading and encourage investors to stick to the intended long-term horizon. This fee is usually waived completely after the initial lock-in or specified period ends.
And finally, any other costs?
Yes, there are transaction charges. These are the actual costs incurred by the fund for buying and selling securities, things like brokerage fees, securities transaction tax, STT, audit fees, legal fees, costs associated with derivatives trading. These are usually disclosed separately from the TER and reflect the actual trading activity costs passed on to the fund.
Okay, let's try to put some numbers to this with that example calculation again. Say an investor puts in 10 lakh. The fund delivers a 15% gross return in a year, so 1.5 lakh profit. The hurdle rate is 10% and the performance fee is 15%. Let's assume a 1.5% management fee included in a 2% ER and no entry exit fees as they held long enough. How would the fees roughly look?
All right, let's break it down. Management fee as part of TR. Approximately 1.5% of euro 10 lakh equals 15,000 for the year. Other tier expenses. The remaining near 0.5% of TR equals 5,000. So total TR impact is 20,000. Performance fee. The return above the hurdle, 10% of TR euro 1 lakh is 1.5 lakh euro 1 lakh euro 50,000. The performance fee is 15% of this 50,000, which equals 7,500. Total fees expenses, 20,000 TER plus 7,500 performance fee equals 27,500. Net return to investor. Gross profit of 1.5 lakh minus total fees of 27,500 equals 1,022,500. So the net return is 12.25% on the initial 10 lakh investment.
That example really clarifies how the performance fee interacts with the hurdle rate and TR and how it impacts the final net return. So the crucial advice here for our listeners is always review the latest official scheme information document, SID, and the fund's fact sheet for the exact fee schedule, calculation methods, hurdle rates, and HWM details before you invest a single rupee.
Absolutely. Don't rely on summaries or what someone tells you. Transparency is mandated by SEBI, so use those official documents to understand every possible charge up front. Ensure you're comfortable with the potential cost drag on your returns. Never assume.
Excellent point. Finally, let's talk about managing your SIFs for the long run. This isn't just about getting in, it's about staying engaged. Let's cover monitoring and eventually withdrawal strategies. How should investors approach ongoing monitoring and review? It's not set it and forget it, as we established.
Indeed, ongoing monitoring and review are non-negotiable for SIFs. I'd suggest a tiered approach. Monthly reviews. Quick check. Briefly check the NAV performance against its benchmark, if applicable, or your expectations. Review any portfolio disclosure updates if released monthly. Keep an eye on broad market conditions relevant to the fund strategy. Maybe quickly track the expense ratios and fees being charged if data is available. This is just a pulse check.
Okay, a light touch monthly. What about a deeper dive?
Conduct quarterly deep reviews. This is where you spend more time. Analyze the absolute return and, more importantly, the risk-adjusted returns. Use metrics like the Sharper ratio, return per unit of total risk, and maybe the Sortino ratio, return per unit of downside risk. Assess the fund's maximum drawdown during the quarter or year to date. How did it hold up? Is the strategy performing as expected given the market environment? Review any significant portfolio changes made by the manager, and rebalance your overall portfolio if the SIF's allocation has drifted significantly from your target.
So, checking performance, risk, and alignment quarterly, and once a year. What's the focus of the annual review?
An annual strategic review is crucial for the bigger picture. At this point, you should step back and can 1. Recheck the SIF's alignment with your overall long-term financial goals. Have your goals changed? 2. Assess the ongoing relevance of the SIF's strategy. Is it still appropriate given your market outlook and the evolving economic landscape? 3. Evaluate alternatives. Are there newer SIFs or other investments that might be a better fit now? 4. Optimize your holdings for tax efficiency, perhaps considering any capital gains or losses. This is a macro-level check on your SIF allocations placed within your entire financial plan.
Now, what are some red flags or exit triggers that would signal it's time to seriously consider leaving a SIF, especially since we've emphasized it's ideally a long-term commitment? When should you think about breaking that commitment?
That's a critical question. There are definitely potential red flags that should prompt immediate investigation, if not necessarily immediate exit. These include consistent underperformance, the fund lagging its peers or relevant benchmarks significantly for a prolonged period, say more than 6-12 months, without a clear explanation tied to its specific strategy. Strategy drift. The fund manager seems to be deviating significantly from the SIF's stated investment objective or strategy without clear communication. Key fund manager departure. The star CIO or fund manager responsible for the strategy leaves the AMC. This introduces uncertainty, regulatory issues, or violations. Any significant compliance breaches or penalties imposed on the AMC or the specific SIF by SEBI. Significant increase in expense ratios. An unexplained hike in fees that wasn't disclosed earlier. Poor transparency or communication. Consistent delays in disclosures, lack of clarity in reports, or difficulty getting information from the fund house.
Okay, if those red flags appear and investigation confirms concerns, what's a systematic exit strategy? You probably shouldn't just panic and hit the sell button immediately, given the potential liquidity issues and costs.
No, absolutely not. Panic selling is really wise. Have a planned exit strategy before you even invest, ideally. But if flags appear, follow a process. 1. Performance review threshold. Use your predefined threshold, for example, underperformance for 6+ months, to trigger a formal review, not an automatic exit. 2. Analyze root cause. Is the underperformance due to a temporary market mismatch for the strategy, or does it indicate a fundamental breakdown in the investment process or manager skill? 3. Identify alternatives before exiting. Research and select a suitable alternative investment for the capital before you redeem from the SIF. Don't just sit in cash unless that's the plan. 4. Optimize for tax. Consider the tax implications of selling. Can you offset gains with losses? Is it better to hold slightly longer to qualify for LTCG? 5. Consider gradual exit. Unless there's an urgent reason, like fraud, consider redeeming gradually over 2-3 months, if redemption terms allow, to mitigate the risk of bad market timing on your exit day.
Moving on to long-term planning, specifically retirement. How do SIF allocations and withdrawal strategies need to change as you approach or actually enter retirement? The risk profile changes dramatically then.
Absolutely. The time horizon is key for SIF allocation and retirement planning. As retirement nears, the typical advice is that SIF allocation should decrease significantly, perhaps even to zero for many, due to the heightened concerns around liquidity, volatility, and the need for capital preservation and predictable income streams. You generally want more stable, predictable assets funding your retirement lifestyle.
Can you give us some rough suggested SIF allocation ranges based on the timeline to retirement? Keeping in mind these are just guidelines.
Sure, as general guidelines, 20+ years to retirement. Younger investors might consider an 8%, 12% allocation to SIFs as part of their growth engine. Withdrawals aren't a concern yet, and reinvesting earnings can help manage volatility over the long term, 10, 20 years to retirement. As you enter the accumulation phase closer to retirement, perhaps reduce SIF allocation to a moderate 5%, 8%. Start thinking about potential withdrawal strategies, maybe using a dynamic withdrawal rate notionally, like 4-6%, to model long-term sustainability.
And closer to the finish line, or once you're actually retired.
With 5-10 years until retirement, a lower allocation of 2%, 5% might be more prudent. The focus shifts more towards capital preservation. You'd prefer conservative withdrawal rate assumptions in your planning, And regular portfolio rebalancing becomes even more critical. Less than 5 years are already in retirement. For most people, minimal or no SIF allocation, 0%, 2%, is generally advised. The focus must shift to highly liquid, lower-risk assets, like bonds, annuities, FDs, to support immediate and near-term withdrawal needs reliably. The sequence of return risk is too high with volatile assets when you're drawing down capital.
So again, the general rule of 110 or similar concepts still apply to your overall equity exposure. And SIFs are just a high-octane part of that which needs careful management, especially near retirement. It all ties back to your personal risk capacity and needs.
Exactly. And it's vital to remember these are just guidelines. Your personal risk tolerance, your other income sources in retirement, your health, your specific financial goals, these should always be the ultimate decider for your appropriate allocation. There's no single right answer.
What are the key withdrawal considerations, specifically when you do have SIFs, even a small allocation, in your portfolio during retirement? What risks need managing?
The biggest one is sequence of returns risk. Drawing down money during a market downturn early in retirement can cripple your portfolio's longevity. Because SIFs can be more volatile, withdrawing from them during a slump can be particularly damaging. Using dynamic withdrawal strategies, taking less when the market is down, more when it's up, rather than fixed withdrawals is crucial.
And withdrawal rates.
For withdrawal rate guidance, the old 4% rule is just a starting point. With longer lifespans and potentially volatile assets like SIFs, a more conservative initial rate, maybe 3.5%, 4.5%, adjusted annually for inflation and portfolio performance, is often suggested. Flexibility is key.
And liquidity remains a constant theme with SIFs, right? Even in retirement withdrawals.
Yes. Ensure that the non-SIF portions of your portfolio, your bonds, cash equivalents, provide sufficient immediate liquidity for your regular living expenses. You don't want to be forced to sell a SIF, potentially facing delays or exit loads or selling into a downturn just to pay your bills. Match your liquidity needs carefully. And of course, regular rebalancing is vital. Actively shift your allocation away from aggressive SIF exposure towards safer fixed income or bonds as you progress through retirement to manage risk.
Let's wrap this up with some smart money moves, tax-efficient withdrawal strategies. This gets complicated with different account types and assets like SIFs. How does this sequence of withdrawals matter when you have SIFs as part of a diversified portfolio with taxable accounts, PPF, EPF, etc.?
Sequence definitely matters a great deal for maximizing your after-tax income in retirement. The general principle is to try and defer taxes for as long as possible, letting assets grow tax-advantaged and pay lower tax rates where possible. So, a common strategy is 1. Withdraw from taxable accounts first. Sell assets held in your regular brokerage accounts first. Why? Because capital gains, both short-term and long-term, are often taxed at lower rates than the ordinary income tax rates that apply to withdrawals from traditional retirement accounts like EPF or MPS, post-annuitization. You might pay 10% or 15% LTCG instead of your 20% or 30% income tax slab rate.
Okay, taxable first. Where do SIFs fit in? Before or after retirement accounts?
Generally consider SIF units strategically, often after exhausting a good portion of your taxable accounts, but potentially before tapping heavily into tax-deferred accounts like EPF and PS.
Why is that?
Because SIFs, being taxed like equity or debt mutual funds, generate capital gains. By holding SIF units for over 1 year, you can benefit from the lower long-term capital gains LTCG rates, currently 10% after the 1 lakh annual exemption for equity gains. This LTCG rate might be lower than your ordinary income tax slab rate. You can try to coordinate SIF withdrawals with years where your overall income is lower, or use withdrawals to deliberately harvest tax losses if available, offsetting gains elsewhere.
So taxable, then SFs focusing on LTCG. Then what about those traditional retirement accounts like EPF, PPF, NPS?
Defer withdrawals from tax-deferred accounts like EPF, NPS, traditional FDs where interest is taxed annually, for as long as is practical or legally required, for example, RMDs. These accounts grow tax-deferred, so letting them compound longer is beneficial. When you do withdraw, it's usually taxed as ordinary income at your slab rate, which might be higher than LTCG.
And things like Roth equivalents, if available, or PPF where withdrawal is tax-free.
Preserve tax-free accounts, like PPF where the withdrawal is tax-free after maturity, or any Roth-like equivalents, for last. Since they grow tax-free and withdrawals are tax-free, they are the most valuable assets to keep compounding for the longest possible time. Use them towards the end of your withdrawal sequence.
And we need to remember required minimum distributions, RMDs, from certain retirement accounts.
Yes, you must plan around required minimum distributions,
Yeah.
RMDs, mandated by law from accounts like EPF or NPS after a certain age. Ensure you withdraw enough to meet these requirements, but try to time your other withdrawals like from SIFs or taxable accounts, strategically around these RMDs to avoid unnecessarily pushing your total taxable income into a higher tax bracket for that year.
This sounds complex. Professional advice seems key here.
Absolutely. Tax planning with layered investments like SIFs across multiple account types is genuinely complex. Consulting with qualified financial and tax advisors can significantly improve your after-tax portfolio longevity and retirement income sustainability. They could tailor a withdrawal strategy to your specific situation.
So, to quickly summarize the general tax-efficient withdrawal sequence we discussed. Taxable accounts first, then SIP units, preferring LTCG where possible, then tax-deferred accounts like EPF NPS, and finally, tax-free accounts like PPF.
That's the generally recommended sequence, yes. It aims to maximize tax advantage growth, minimize your overall tax bill throughout retirement, and optimize your portfolio's longevity. It's a strategy designed to make your money last longer and work harder for you after taxes.
Well, we've certainly journeyed deep into the intricate world of specialized investment funds today. We've gone from their core definition and strategic advantages through the detailed fee structures, peered into the current market landscape, and covered those crucial considerations for both entry and exit. We even got a glimpse into how a leading player like Edelweiss is approaching SEFs, and most importantly, how you as a discerning learner can approach them thoughtfully, responsibly, and with genuine insight.
Yeah, it's been quite a comprehensive exploration. I think the real aha moment here, the key takeaway, is recognizing that SEFs are undoubtedly a powerful, sophisticated tool, but they truly demand a different level of engagement and understanding compared to traditional investments like mutual funds.
Right.
They effectively bridge a significant gap in the market, offering advanced strategies more accessibly. But navigating that bridge requires care, diligence, and self-awareness, especially given the 10 lakh minimum investment and those inherently higher risk profiles we discussed. It's really about being an active, informed participant in your financial future, not just a passenger.
That's a great way to put it. So here's a final provocative thought for you, the listener, to mull over. As the investment landscape inevitably continues to evolve, new categories like SEFs will keep emerging. The question isn't just what new product to invest in, but how thoughtfully you commit to understanding it before you do. How will your increased knowledge of SEFs gained today challenge your current portfolio strategy? And perhaps more broadly, what other gaps or opportunities in the investment market are you now curious to explore as a result of understanding this evolution?